Hey, it's me, Mitch Goldberg. You're watching Be the Boss of Your Money. It's a show about helping you to take control of your money, of your financial situation. This does not mean that it doesn't mean that you need to be completely independent. It doesn't mean you shouldn't use a financial advisor like moi, but what it means is that you need to have the sense to know where the moving parts are in your portfolio. The bird's eye view, the granular view, granular, that's like granular is like the new, you know, buzzword in Zoom videos. You have to take a granular view. Okay, so, but you need to take charge. It doesn't mean you turn everything over necessarily to someone else for decision making, but you need to have that sounding board. You need to have that person who keeps you on track. You need to have somebody who could be your consultant to your finances, your personal finance, your mortgage borrowing, your investing, your retirement planning. All of those things come into play. That's what the show is about. I want to give you as many tools as I possibly could. I share with you everything. If you've been watching me for the last couple of years, I've shared plenty, plenty, plenty of free information to help you do better. And you could take that information and I think pretty much for many of you do everything yourself if you use all the information I've given you. But it's one thing to listen and take down notes and have all this information. It's another thing to actually execute on the plan. It's another thing to have the accountability to do everything on your own. So I hope you're getting value out of the show. And if you decide that your financial life could benefit from an accountability partner like myself, someone with experience, someone who can help you make informed decisions based on your inputs, on your time horizon, your risk tolerance, someone who can educate you about money in general. That's what you hire us for. Okay. So we're going to talk a little bit about Nvidia. Tech stocks continue their slide. Small caps gave back a little bit after a huge run over the last couple of weeks. The Dow nosedives another 500 points. And what's going on here? Well, we have an interest rate cut rather, coming up in September. Markets are betting almost 100% that that's going to happen. And we'll talk a little bit about politics because how could you talk about the market and money if you don't talk about politics on this day, the fourth day of the Republican National Convention? So I'll roll a quick intro and then we'll just do a quick brief here. Here we go. All right, welcome back. So when we, by the way, while you're watching this, whether if you're watching in the live stream or if in the replay, don't forget, give us a thumbs up. Don't be bashful. It's great to see that. It helps encourage me to keep developing more educational content. If you have any questions, please ask me in the comments and I will get back to you. I will see those questions and I'll get back to you. And that's actually the best part about doing this. So I love hearing from you. All right. And if you want to reach out, just check out clientfirststrategy.com. And we're pretty easy to find. So let's just first mention politics. Okay. When we get into politics, when I do, I'm not getting into the bashing part where, oh, they're killing everything, they're going to ruin everything. And, everyone's shouting over each other. Now, what I do is when I get into politics with my clients, is I get into how could policies, new tax rates, for example, IRA rules, IRA distribution rules, required minimum distribution rules, inherited IRA rules. I get into these things because I use all of that to help you. Because we have the knowledge, we take that to help you achieve a potentially positive outcome for your situation, for your retirement, for your future plans. Future plans rely on money. That's why money's so important, and it gets more important as you get older, right? So we'll just talk quickly municipal bonds. This is a big topic. Municipal bonds are a major part of the fixed income market. Municipal bonds are issued by municipalities like cities and states and towns and school districts. And typically they pay a lower interest rate, but the deal is they are free of federal income tax and often they are free of the state income tax of the state that they're issued in. So if you're a New Yorker and you buy bonds issued within the state of New York, not only would you avoid paying federal tax, you'd also avoid paying the state income tax as well as potential city tax. So if you're a New York City resident, for example, and that goes for other states. Now, some states don't have a state income tax, so it's less important. But the point is, tax rates are expected to go up in 2026. Congress and Trump passed the Tax Cuts and Jobs Act, and that lowered tax rates for 10 years. With the sunsetting of those lower tax rates beginning or at the end of 2025, so beginning 2026, tax rates go up to where they were 10 years ago. If that happens, it makes municipal bonds more valuable to investors who are in high tax brackets. If it doesn't happen, um, there's still a place for municipal bonds. I think they're still valuable for the right client. This is not blanket advice. It's everything is based on the words for the right client. But then it still keeps treasuries as competitive, even though you pay federal tax on those, they do pay higher rates. So these are the kinds of things that we look at when we talk about politics and how things could change. Because if former President Trump wins, we would expect those lower tax rates to stay low, maybe even go lower. If President Biden wins re-election, then we expect tax rates, at least on people making over $400,000 a year, to revert back to where they were 10 years ago. Also expiring is sunsetting is the SALT Act. So state and local taxes are not deductible for about 10 years, but in 2026, that expires and they could become deductible again. We'll see how that goes. But if tax rates go lower, if the SALT deductions, they're limited at $10,000, but if they go away and you could just write off the full amount of your real estate and state income taxes, well, that actually could help blow a bigger hole in the national deficit and the debt level. So there's a lot of things to be spoken about, and we'll see. And it's going to be very interesting to say the least. So I'll be here monitoring all this for you, helping you make the appropriate adjustments to your plans and your investing. And those are the kinds of things that a financial planner does. Let's get into it. Thank you for the like. We got a like over here. Who is that? Ooh, Tom, hey, Tom, thank you very much. You're always out there supporting me, and I greatly appreciate that and hope you're enjoying your retirement. And, you have questions about your retirement plan and all that, rolling over your 401k, you know who you could call. You've got a friend in the business. And if you don't use me, that's okay. We're still friends, and I appreciate you taking the time. So we talk about Nvidia a lot. I spent a lot of time talking about that, and I got, I mean, not hate mail, but I got comments like, how could you, or people shocked, how could you possibly talk about selling Nvidia? Okay, I didn't come out with a blanket sell on Nvidia. I'm not a stock analyst at a major brokerage firm where I either put a buy, sell, or hold on a stock. What I say consistently is there's a number of factors. Some of you, for example, you could have 10% of your investments in Nvidia, and that's okay. Some of you could have 2% of your investments in Nvidia, and that's too much. It's different for everybody. But my point is, as these stocks go up a lot, take a bigger portion of my clients' accounts, of my clients, I like to scale back the position a little bit. And that's really important to a lot of people, not everyone, but to a lot of people. I'll tell you why. It's because if you have Nvidia stock, the individual stock, I don't mean if you have it as part of an index fund or some mutual fund or something. I'm talking if you have the individual stock. From my experience, if you have it, you probably have shares of Google and Facebook and you probably have lots of others. You probably have Netflix, right? All the FANG stocks, Tesla. It's so Microsoft, Apple wouldn't be the only one you have. So what happens is not only did Nvidia go up, I mean they went up the most of those big mega cap stocks, but the others went up too. And you wind up with such a big portion of your portfolio that's just tech, that when one has a correction, they typically all correct. This is more of an asset class move than just individual stocks. And that's why you may be violating your principles of diversification by having these individual stocks and not scaling them back as they go up. Some of you scaling back might not make sense. Some of you it may make sense. My personal view is nothing, trees don't grow to the sky, and I like to scale back individual stocks to a position that if they went down by 50% or more, they wouldn't be a death knell to my clients' financial future because they could have lost so much money in their investments. By the way, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. And diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Now, this isn't to say you specifically, the viewer, should watch Nvidia. I'm not giving that buy or sell recommendation. I only give buy and sell recommendations when I'm speaking to somebody and I know their situation. And then we could talk specifically about what the prescription or advice would be. So what I want to say is that I told you all about Nvidia, and I gave you my view. That's all, just my view. You're entitled to your own view, but I am the 230-pound financial advisor in the room, and I've been doing this for over 30 years. So I think my experience and my opinion counts for something. That's why my clients use me, right? Because they believe in and value my opinion. But I never, okay, I never want my clients' financial security to be dependent strictly on my opinion. That's not a good thing. Okay. I don't want it to be just on my opinion. What I want is to use what we have, the tools at our disposal, to make sure that I'm giving you the advice that is appropriate for your unique individual situation. So we talked about that, and I've been posting. If you follow me on social media, I've been posting about taking some profits. For some of you, it may make sense in Nvidia. And people would come up to me and, in my little neck of the woods and say, I'm not doing that. I don't think so. And I could be wrong. But if you look at how these stocks are right now, I just want to show you, do a share screen with you. All right. Let's go take a look at these stocks. All right. If you see this, you see that red at the end, these stocks were all recently at highs. Meta, look how big that red gap is getting. Same thing with Nvidia. I mean, these companies are giving up, 20% of their value, right? A fifth, 15, 20% of their value. Tesla, even more. Netflix, Microsoft, Google, Apple, Amazon. I mean, Amazon's high was 201. And now it's 183. So, it's a 10% drop. So they're starting to give it back a little bit. Let's take a look at how they're doing in after hours trading. All right. How are they doing? Let's take a look at Netflix because they just announced earnings, and Netflix, they had a okay quarter, but I don't know if it was good enough. And there's Netflix down another dollar, and aftermarket trading was up a couple of minutes ago. But subscribership growth is nothing special, and they've gotten so big. I don't even know how they get more subscribership growth. But hey, that's just my own opinion. And let me make this a little bigger because I want to get that guy off my screen. Okay. And let's take a look at how the major averages did. The Dow down over 500, NASDAQ down over 12, S&P down 0.78, 10-year yield up slightly to 4.2%. The VIX has been going up. That's been around 12, 13. That's almost 16. So watch out for that. A little fear has been creeping into the market, all about the profit taking. And let's look at the Russell 2000. That was down almost 2%. That's the small cap index that's been hot as a pistol lately. And that's down almost 2%. Finally, a little profit taking, but it's still up substantially in the last couple of weeks. So a little profit taking is normal. Is the rally in small cap and mid cap stocks sustainable? Is it here to stay? My own experience is that when small caps and mid caps rally, they have a tendency to rally for very long periods of time. And these stocks aren't quite at their all-time highs yet versus, for example, the Nasdaq, S&P, and Dow, which have been hitting their all-time highs. So the betting that a lot of people feel, the feeling that the feels that people have is that, the Russell 2000 index, the small cap index, and the mid cap index, these could continue rallying for a very long time. And I think that's why so many investors are willing to chase them here, because this is probably just the start if history is any guide. And when it does come to markets, history is a really good guide. That's why technical analysis works so well. History is just a very good guide for markets. So that's why investors are, continue to be so enthusiastic about small cap and mid cap, even though they've had a pretty big rally. So that's it for the show today. I greatly appreciate you watching. I'm going to get while the getting's good. Have a good night. If you need me, you know where to find me, and I would love to hear from you. All right. Peace out.